Good evening, guys. So yesterday we actually talked about the basic thing about price action. Whereby we discussed about the supply demand, what we mean by resistance and support, why they are not using resistance again, why they are using support, and how all these chart patterns were being derived, you understand, from the law of demand and supply. You understand? So briefly, we talked about the two things that actually move the market is the supply and demand normally. So I will actually made various examples yesterday. But we actually did the class twice. It was only the first part we could actually get the recorded part. The second one, I actually don't know where the recording this thing template went to. You understand? But the second one was actually like 15 minutes. It wasn't up to 15 minutes or 10 minutes. So still we are still okay since we have the first part. So that was much of our time today. We'll just be talking about the SMC. Things we need to know about the SMC, you understand? But obviously, I was saying yesterday that for it, we're actually talking about knowing the basics of trading. That I expect you to know some little things. And I was talking about the higher highs and higher lows, validation of uptrends and downtrend. That okay, fine. The market is in an uptrend, then there has to be an higher low. Low for a market that is in an uptrend, the validation there has to be like a higher low, higher high, higher low, higher high. That is, this will be the higher high, this will be higher low, higher high, higher low, higher high, higher low. That is the creation of new higher highs and new higher lows. Why that of downtrend would be the creation of lower high and lower low. You understand? That is, if we form a high, a new low, a new lower high, a new lower low. It is lower because it's in the downtrend. It is higher because it's in the higher trend. In the uptrend, sorry. So that's that about that. So now today we'll be talking about three things basically. We're talking about the fair value gap. We're talking about three things. We're talking about the fair, sorry, talking about, okay, let's just talk about the imbalance. Talking about the OB, which is the other block. I'll be talking about what? Imbalance will be equal highs and low. What else? In general, let's talk you talking about points of interest. We're talking about these things. Let me try and zoom it. So we're talking about these three things. Four things rather. You can call this POI. So when we're actually talking about imbalance in the market, I will be explaining this thing to be, I said we are extending it to tomorrow, which means tomorrow we'll be live trading together. We'll have to like analyze the market against Tuesday. So now, if you're actually talking about OB imbalance here, you understand? I will explain everything in such a way that you understand the meaning and why imbalance is actually there in the markets. You understand? So that's about that. So now, imbalance, let me say, okay, let's go practical. Let's go practical. I will show you what we mean by imbalance now. Imbalance is also called fair value gap. You understand? People call it fair value gap. Just like I was telling you yesterday that this first breakout of a twin, other we can call it turtle soup, we can call it spring. But what really matters is you understand the psychology behind it. So now I'll be talking about imbalance and OB now in a very fast way. Now, imbalance let me say, do you know we're talking about the rate of buyers must be equal to the rate of sellers yesterday too as well. You understand? So now I'll be explain everything now because everything actually enters into that. You understand? So now imbalance or fair value gap are being created in the market when there is a powerful movement. You understand? From a particular period of time to a particular period of time. So how do you now spot these things? How do you spot these things? How do you spot this powerful movement? How do you know that, okay, this is the fair value gap, this is the market already creating an imbalance? Now, if you notice, Okay, or for a better reasoning, before I go to psychology to the explanation. Now, fair value gap or imbalance consists of three candlesticks. You understand? Let me zoom this. Now, in this candlestick, you're using the high and low of the first candlestick and the high and low of the third candlestick. You understand? Now, let's use this candlestick now because these are like powerful movements. You understand? Powerful movements that we can actually spot. That is the way the markets move here. Like the buyers move with pressure compared to here. You understand? You understand what I'm saying now? So this is what we can call this what a powerful movement. Now let's see if the market actually created an imbalance in the powerful movement. Now I said we're using three candlesticks, you understand? So now to know the fair value gap of this bluish move, we'll take the first candlestick, that is the eye of the first candlestick, which is this place here. I'm trying to zoom in there. This is this place here. This is the first eye. The eye. Then we'll now take the low of the last candlestick. You know, we're actually using three candlesticks. 1, 2, 3. Now, 3. You understand? Now, the space between the first candlestick and the last candlestick, the high of the first candlestick and the low of the third candlestick, if there's space if there's space there, that is maybe the low of the last candlestick has not actually like mitigated, or the low of the last candlestick has not actually touched this particular price before, then we'll say that the market has created a fair value gap, or we can say there's imbalance in the market, which is like from here to here. And our belief is that sooner or later, the price of the market is actually going to come and feel the particular imbalance in the market, because we say the rate at which we buy must be equal to the rate at which we sell. And if you later look at it, the market came to that particular place and filled it. You understand? So that's that about that. Let's look for another example that we can actually play with. We have so many examples. Just know that what the market is trying to say, that once an imbalance is actually created in the market structure, it means that the price of the market, before it's actually continuing in any direction it wants to move, it will still come back to there. So now, if you actually use this and okay, if you use this powerful movement as well, you see that the market actually came back to touch. If you're using this first candlestick, these three candlesticks, 1, 2, 3. Let me draw it again. So after this, we go to the bearish example of fair value gap. Now you see that this is the first, this is the third candlestick. We are using the low of the third candlestick. You see that after the market created this imbalance, you understand, it came back to fill the imbalance. That is, came back to touch the tip, can you see, of the first candlestick, of the eye of the first candlestick. You understand? Now, if you switch to a lower time frame, this is a 24 hours time. If you switch to a lower time frame, you also see that imbalance was actually occurred there. And if you notice so again, the market came back sooner or later to fill the imbalance too. You understand? Do you understand? So that's that about fair value gap. So let's look for an example of a fair value gap in how will I say it? Now, thank God for this. Now, a question is, should I consider this as a fair value gap? What actually happened there? Now, we said we'll actually be making it of three candlesticks, yes. Now, if you're actually going to make it of this 1, 2, 3, you will see that the low of this first candlestick and the high of this candlestick, they're already into each other. That is, it has already, like, the market is actually balanced around this particular spot. Okay, if you say you want to use these candlesticks, then this 1, 2, then 3. If you notice the low of this candlestick and the high of the third candlestick, they've already was, I don't know if you can see it. They've actually like touched each other. That is, the price has actually balanced itself. Let me try and zoom it in very well. Can you see? So now we can't call this what? Imbalance. Yeah, I know the market actually came back there, but like, to me, it's no more imbalance, because the market actually like balanced itself. You understand? So instead, we look for, now the funniest thing now is this and this. You can still call this as long as the low and the high of this has not actually like mitigated each other. So you can still say from year to year, there was what? There's imbalance around this particular zone. FPG. You can call it FPG. Fair value gap. It's same as imbalance. But everybody tends to make all these terminologies hard to chase people away from the market that is hard, is hard, is hard, is hard, is hard. There's another name they use for that block now that, bro, if you actually see the name, you don't want to like, you be like, bro, this thing is a lot, it's a lot, it's a lot, it's a lot, it's a lot. Now, let's show other examples. Now, these three candlesticks, 1, 2, 3, imbalance from year to year. Now, 1, 2, 3, imbalance from year to year. 1, 2, 3, imbalance from year to year. So we believe that the market sooner or later one day we clear this. I'm going to pack them all together since the imbalance is from year to year, from year to year. I'm picking the candle 3, 3. I don't know if you understand what I'm trying to say. 1, 2, 3, imbalance is here. 1, 2, 3, imbalance is here. 1, 2, 3, imbalance. So I'll just say like there's imbalance in the complete move like this. That's what I'm trying to say. So I believe that sooner or later the market will feel this imbalance. So let's see if that actually happens. Okay. And glory to God, you see, markets came back and filled everything. Imbalance here too. So it came back to fill everything. See to that time frame, you see that there's still an imbalance here too. You can see there's an imbalance here too. Definitely the market is actually going to come to this particular place. Imbalance here too. You understand? So it's not as if you actually trade a low with this imbalance, but just for you to know that okay, the market is still coming here. Just know that right back of your mind that the market is still coming here. That's one against one. So now this will lead us to the other block. We have type of other block. You understand? We have type of other block. We have the bluish other block and bearish other block. Now there's a time I was actually like interchanging this name for each other. But I think to me, I was still even profitable with them because to me, what really mattered then is the psychology. Do you understand what it meant? You understand? Not that it's not you know what the name they are calling a particular candle or like no, even though you know the name they are calling a particular candlestick, doesn't actually give you the psychology behind trading. You understand? What really matters is you can actually know the psychology behind trading. I don't know the name that they give all these things and be profitable. But now let me just go to what I'm saying. So now the short form of this, let's make the short form, let's make their short form, let's make the short form of this to be everything is BOBO. Okay, let's make short form is BUOB. Then short form of the bearish to be BEOB. You understand? So this is for other block, type of other block. So now, like I was saying, other blocks are or you know I was saying yesterday that the easier way for you to make it in trading is that this trading actually wasn't designed for us. It was designed for these big people to make money. And the thing that can actually pay us, because another says that when 12 are fighting, I like him that I did, that is the grass that will suffer it. And we look like actually we don't even look like the grass, we are the grass. You understand? So we can only be profitable when we know when these people want to place their trade. We can't go against them. We don't have what it takes to go against them. You understand? What we need to know is what does Tesla, what does Apple, what does Facebook, what do they want to do? Do they want to buy or do they want to sell? You understand? And they want to buy, it will be a good opportunity for us to join them and buy the market. Not that because they are buying, you not place sale, you get liquidated. You don't have what it takes to face them. You understand? So that's about that. So now, the question I asked myself, or I asked us yesterday was like, how are we going to know when they want to place a trade? You understand? Now, this will lead us to other blocks. You understand? Other blocks are like indicators that shows us that, okay, these particular institutional traders have placed an order around this particular price. And normal, if you should place a particular price at a particular place, sooner or later, you are doing it for you to make money. You will actually have to take your money at the end of the day. I don't know if you understand what I'm trying to say, but at least there will be a sign that, okay, this person actually took their money, placed a particular trade here, and they are trying to like take a profit around this place. You understand? Those are the work of other blocks. You understand? And all these things, we will still be working with them around price action. You know, I was telling that before you know the law, before you can break the law, you have to know the law. You understand that? That's this thing about inconsistency of a thing. And that will still be the same model we'll be using. You understand? So today, yesterday we talked about price action, the chart patterns and stuff like that. Today we talked about the higher low, and we are diverted to SMC. So tomorrow we'll just be teaching about models and strategies alone. Understand? We think that, okay, if you actually just go to strategies now, you guys may actually be having issues. That's why I want to like broach you guys with all these like necessity. You understand? Because it will actually be, it will be funny when I'm actually like making some or saying some terminologies, like speaking some names. I will be like, what do I mean by BOB now? What do I mean by BOB now? What do I mean by OB? What do I mean by POI? What do I mean by EQI or EQ EQL? You understand? So now that's why I'm actually like trying to take my time to brush you so that we won't have any complications tomorrow. You understand? So now, and other blocks is now all these things actually work together. Other blocks and imbalance works together. So I will explain everything again inside each other again. Now, another block is the last candlestick. You understand? Before or after, or let me use the word before institutional traders placed a trade. You understand? So how do you know? Well, like that sounds weird, right? Now, if this particular market is supposed to sell before, the instance was selling before. You understand? And suddenly it just went up with this powerful movement. Yeah, of course, there will be a powerful movement, because the only thing that can actually make a powerful movement to occur in the market is when what these institutional traders place their trade. You understand? So in short, these institutional traders are the one that causes imbalance in the market structure. Are we getting this now? So now, how can you spot your other blocks? Your other blocks are the last candlesticks, the opposite candlestick before what? Before this expansion occurs. For instance, now, there was a powerful pressure movement bluishly. You understand? So definitely, the last opposite candlestick, the powerful movement is what? Is bluish. And I said the last opposite is what? Is the other block. So definitely, this weird candlestick is what? Is the other block. I don't know if you understand what I'm trying to say. So you call this what? The bluish other block. You understand? It's another block for the bluish move. So you can just call it VO. VO. So tomorrow, I will tell you about the tradable order blocks and tradable fair value gas, imbalance, and everything. So this is what BUOB. This is a BUOB. It's a bluish order block. You understand? So yes. This is another what? Another other block. Another powerful movement. Another what? Another other block. BUOB. You understand? Which means that it's showing a sign that the traders actually place their trade around this particular position. You understand? And that what made the markets to go powerfully. So we've talked about the bullish order block now. So let's spot our bearish. Okay, this is another order block here now. Another BUOB order block here now. And if you notice, all these other blocks always occur. When you spot these other blocks, you always see what? Not always, but most time you always see what? You always see a powerful movement that will create a what? Imbalance in the markets prices. You understand? So let's spot since we've actually spotted for the bullish order blocks, let's look for the bearish order block as well. Now, this one actually, okay, can you see? Imbalance in the market structure, 1, 2, there's imbalance here. So definitely this is what? A bearish order block. This is a bearish order block. I'm talking about this. So we can call this BEOB. These are the things you actually have to spot in trades before you actually think you want to make a decision. You understand? BEOB. Now, let me explain what this order block means. If I'm to, okay, let me explain graphically now. You have to invest a particular period of money. Maybe I have a company, name of the company is Trades. You understand? I'm an investor, right? If I want to actually like invest in this company, I'm investing in the company that I can actually take, I'm investing in sorry, I'm investing in the company because I actually want to be profitable. And at the end of the day, I will take my capital and my ROI away from the company. That's it. So now, if the company was at this level before, then if I should invest in that company, the company in this thing will pop up normally. You understand? You understand what I'm saying? Normally, and if it actually gets to this particular period of time, I would have actually been profitable because the market was at zero before, the 0 year before. But I invested, it's pumped. So I can start to take my profit around this particular place. That, okay, I'm not investing again. I've actually seen enough profit. Mind you, if that company doesn't see another investor around that particular period of time, do you know what will happen? The rating of the company will come back to what? To its initial position. You understand? So that's just the meaning of other blocks. So another block will actually form here, creating a powerful movement immediately because it's not as if I'm investing small. I invested once. So it will pump it up, like, okay, fine. And when I take my money away, it's come back to the initial position. Now, this is a one-man investment analysis that I actually use for you. Now, assuming we have 5 investors, you understand? Immediately I drop my money, another person will be like, should be investor A invested in art company and he got his profit. So let me invest too. Investor A invested 10 million. Let me invest 20 million. So, and if investor B should invest 20 million, after I took my capital and my profits, that the platform actually went back to normal initial rating. You know that the platform actually increased again to this particular thing. And in the focus, if investors should see that, oh, investor B is likely to take his money just like investor A did, because that's actually trading normally. This is like the game of chess. Like, even let's forget trading, this is like psychological reasoning, like because somebody has done it again, another person wants to do it, judging what another person has done to predict what's actually going to happen in the future. Investor C might be like, okay, before investor B takes away his money, let him put his own money. Let him put 30 million. Now, investor B might decide to be like, okay, he wants to take half of his money and put half of the money again back inside this thing. So unfortunately, maybe it was here when investor B took half of the money. Investor C will just input 30 million and boom, the market will go up. Will it be profitable for both investor B and investor C? You know what I'm trying to say like that? So now that's just like normal listening. But in short, what I'm trying to say is, I'm coming on. I'm trying to do this thing. In short, what I'm just trying to say is that other blocks work the same as well. You understand? Someone invested or someone, let me just say, someone invested in this particular pair. That was why another block was spotted as well as the fair value gap, which means the person might tend to take his profits anytime. And when the person does it, it actually has to come back to the particular place it was before the person invested. So that's what actually happens. So psychologically, it's trying to tell you that, okay, when another block happens, you understand, the market will always come back to that other block to mitigate it. So that's just it. So you already know that these people placed a trade. You understand? What you're just looking for is the particular price that they will take away their money. Because you know when they take away their money, because of the market was before. So the other things you look at too, to know when they want to take away their money. You even look at other blogs too again to know when they want to take away their money. Because these institutional traders are actually trading against themselves. You understand? Though you won't know that, okay, fine, no, this other blogs belongs to Tesla, this particular other blog belongs to Facebook. You understand? But other blog is other blog. Institutional traders is institutional traders. When you see another blog, it shows that it's one institutional trader that actually plays an order. You understand? And the same way you are seeing is the same way these institutional people are actually seeing it. So in short, what I'm trying to say is that if you tend to say, okay, when is the right time for you to place your sell? You understand? The right time to place your sell, that's the right time these investors are actually going to take away their money. You can always look for another other blocks too. If this is a bullish order block, you'll be spotting for a bearish order block. At least the market will mitigate that or make the market to come down. I don't even know what I'm trying to say. Let me use it as an example. This short one. Now, this was a bearish order block here. Creating a very value gap. Then before we knew it, the market actually created another incoming. See what happened here. This is a bullish order block. This red candlestick. You understand? If you see, okay, immediately this traders placed their trade, market went up. And when it's actually mitigated this bearish order block, it came down. I get what I'm trying to say. So in short, what I'm just trying to tell you here is that you can actually trade other blocks. That is to know when to place a trade and to know when to take a profit. I don't know if you understand that. You understand that? So, but we are not there yet. You know, I'm about just teaching us the terminologies here now. So I don't want to divert inside the models for now. So that's that about the other blocks and psychology behind them. So this will lead us to what? To equal highs and equal lows. Now, let's say you can actually round things up with 5 minutes with these equal highs and equal lows, because they don't really have a lot of things like that. We've actually discussed about the two important things, which are the fair value gap and the bearish order block and bullish order block. Now, remember yesterday we were talking about resistance support, and I was like, oh, fine, before that the price of the market, what they do is that if it comes here, it comes here, it comes here, then when they saw that, okay, they can't be actually accurate again, what they do now is they tend to make the price of the market a little bit higher than blah. Yes, you understand? Now, this SMC strategy is more or less like spotting liquidities, because you know we said this international traders, they are doing this thing for them to make money, not for us to make money. You understand? So they have to know the law before they can break the law. You understand? So before you can actually reason or trade like them, you have to think like a composite man that, okay, fine, if I want to take these people's money, okay, this is what they will do. And since I already know what they will do, let me go against what they will do. You understand? So that's liquidity. So equal high and equal lows is more like spotting liquidities in the markets. These are what will actually make us to know where our liquidities are. You understand? Don't worry. With time, tomorrow, we understand the equal highs and equal lows better. In short, what I mean by equal highs and equal lows is just that they are very equal. That is resistance. You can call them resistance. You understand? But in this modern days, you call them equal high or equal low. Because the belief is that when there's an equal high, if the price of the market should go near it next time, you know what he wants to do? To just come here, do that first breakout of a thing we discussed about, then falling back. Same thing applicable to equal low. If something like that should happen for equal low, it should just go a little bit, then what? Come back and break the equal low too as well. And break the equal low. See the equal low here as well. When you spot an equal high or equal low, what it's trying to tell you there is that there are liquidity above it. Understand? That is, there are liquidities above it. You can call those liquidities, you can denote them as dollars. You understand? You can call them dollars. Oh, sorry. You can call them dollars. That is, there's money above it. There's money. So what they do is they take the money away. Understand? What they do is they will now take the money away. Just as simple as that. That's equal highs and equal lows. So when you're actually trading, you spot the equal highs from higher time frame to lower time frame. All these things you want to do, you just have to spot everything from higher time frame to lower time frame. It doesn't mean that the other block you're looking for is the other block from the higher time frame, and because you've seen another block in the higher time frame, doesn't mean look like you must look for another block in the lower time frame. Anything you need in the higher time frame, will just give you like a mindset for you to look, okay, fine. whether you are buying or you are selling. That doesn't mean that you not look for other blocks again, you don't have time frame. Because we still have external other blocks, internal other blocks, external zones and internal zones. And what I mean by that is the external supply and demand and internal supply and demand. You understand? No worry, don't get confused. You understand those ones better tomorrow as we try to work things out very well. So that's that about that. So now, what do we mean by point of interest? The class will be off for like in the next 2 minutes. So point of interest, actually, people just always find a way, or let me say this SMC people always find a way to make this complicated. But just calm down. Point of interest comprises of all these three things. That's the core point of interest. So they can only call something point of interest like when these three things are actually involved at the same time. You understand? Point of interest is more like a zone. The price of a particular the range of a particular price of a market to another range. Do you understand? So now, for instance, now you can call this your point of interest because there are two things that actually validate your trade for you, which are the words imbalance and the other block. So I can decide to call this place. Oh, okay, this is my point. Okay, let me make some of this. This is my point of interest. You get what I'm saying? Those are what it does call point of interest. So that's that about that. So we ended the class now because it's less than a minute. So thank you guys. Thank you guys.